Hello guys, glad to have you on board again today. My sincere apologies regarding the previous days whose videos were absolutely unable to be published because of many errors in the encoding right here in YouTube. Really made and created a mess with huge shifting from the video feed out of the audio feed, so it was absolutely impossible for you to watch out those videos. I needed to figure this out, and believe me, it was a hell of a mess to figure out a solution. I finally came up with something that at least seems to be working at that stage, so we'll see how long this can last. But there are still some really huge incompatibilities between some softwares, as for example, I'm absolutely unable to use the magnifying glass I had in the bottom left corner back then, which is creating some kind of software incompatibilities. When I'm trying to record the screen using the magnifying glass, it's creating huge CPU peakings, and I can't really have this working at that stage. So until further notice and until I figure out a solution to this problem, the magnifying glass will have to be put out the game at least for a few days until I find a solution, or if I don't find any solution, I'll eventually replace that magnifying glass by another one that will make this work, or at least do the job. So anyway, now let's get to it. Normally in Friday I'll be supposed to answer your questions right here in YouTube, the question you leave below those videos all along the week. The thing is that today we're already pretty much off the table of the timetable, so I got more urgent stuff to take care of today, and I won't be able to do this. So I'll eventually do it during the weekend or eventually next week to answer your questions, so making a question-like video. But today I'm going to take care of the minimum, which is going to be a swing review of that week, what the closes may look like, what kind of closes I may expect in order to eventually take overweek trades and things like that. So it's going to be a quicker video today, but we're going to stick to the essentials. We're going to start with the Bitcoins, and the problem is that Bitcoins are closing on Sundays and still generally have a high probability to create strong movements throughout the weekend. So the problem is we're going to make a swing review of what I may expect to see during the weekend, but the problem is I cannot see and say before I have those weekly candle closes in front of me. So until we manage to get them, I'll remain highly speculative. So I'm going to give you the two-sided scenarios I may be forecasting, the two most probable scenarios to me, and of course it will depend on the market's reaction out there. So in terms of Bitcoins, what we have today, candle is still not closed, looks like a potential evening star reversal pattern. So if it closes like that, odds are that we may have a lower shadow candle to plot during the weekend. So probably a very bearish kind of of Saturday that could be reversed by a bullish Sunday, closing back into the previous week's range. Okay, so if we have a look at this through a weekly chart, candlestick chart, what we'll have as an opportunity is to get back in there to close above 3,600, but we may have a bearish outburst, probably chasing down the 3,000s, going below 2,900, which is expectable, but it's going to be lower shadow. Expect some kind of a replicate of that candle to be played out here. Huge lower shadow, but getting back into the previous week's range to close. And if we do that, obviously next week is probably going to be bullish afterwards, but that will kind of maintain the pressure, the mystery, as option number two is basically, okay, last week is more than enough volume, what we've already talked about. We've been expressing more than enough volume in here to buy those lows in the support areas, and in that perspective, we'll never ever go below that price and probably have to terminate the week by a bullish reactivation. And generally, in order to do this, this is what we call the harami kind of reversal pattern in a candlestick perspective. Okay, that's one way we could reverse that. And generally, when we do that kind of thing, you take the the previous candlestick, and you generally have to retrace, God damn it, So I'm going to do it. If I want to see them, I have to change the level. So generally, we do tend to retrace. I'm going to reverse and simply use the 61 to 76. This is the area in which generally the Harami patterns are closing. So if we do this, Harami pattern should leave us to make a weekly candle close above 5,800. In terms of dollars. So this is the area in which normally Harami patterns get to close. Option number 2, even more bullish. We're making a bullish fucking engulfing pattern. In this one, we may close above 5,700. It seems really a lot to me. So I would say most probably in a bullish perspective, expect the Harami pattern to play its game in here and to restore closing the week in here. And next week will be essential to see if we truly validate that bottom and get ourselves out of that 3,000 area. Regarding the volume, I'd say yes, we're definitely mature enough. We're in the support area, so I stand on what I already said previously. If your plan is to get your hands into the Bitcoin market, and if you are expecting to buy Bitcoins, you need to have some of them already. It's a must-have. If you want to have Bitcoins, you should have them by now. Not necessarily put it at all in. As I stand on this, sometimes people can misunderstand my messages. So I'm going to stick to what I'm currently doing in terms of my portfolio management. I've been putting 80% of what I wanted. I've been buying it all, but I still have 20% available of cash to buy if we eventually get to that second option that we already talked about, going below 2,900. If we do that, I have 20% cash available to buy those prices. Otherwise, I'll buy those remaining 20% if I have the bullish validation I want to. So if I do have that bullish Harami pattern, I'll put the 20% left in the market and I'll be done with Bitcoin for 2 fucking years. Next step is us reaching out profit-taking area, which is going to be that red line and approximately that price area, but we can expect this to going slowly downward bite by bite. So in the future, I expect us to slowly but steadily breaking the 8,500, but approximately above that price, I'll start lowering my exposition, taking partial gains in order to buy eventual pullbacks, but that's it, all right? It's just, anyway, at that stage, I'll have Bitcoins for at least 2 years, 2 to 3 years. I'll not sell all my Bitcoins. That's not an option. Selling partial gains, obviously I will. I'll manage my risk, meaning getting myself in there. I'll probably take a 50, or let's say 1/3, or 1/3 to a half of my entire position sizing off the table to rebuy them on support. All right, so just expecting some kind of consolidation in here to buy again. So that's all I'll do. Take the money off the table, but not off the account. I'll keep that cash available instantly into Bitstamp to buy if new conditions are setting themselves, all right? But anyway, I'll have Bitcoins starting now, or it's already started a few weeks from now. It already started almost a month ago, as I made the first desert crossing phase kind of bullish entry. But right now, I think, yes, we're mature enough, and you're very late if you still haven't pressed the buying button, as if you wanted to buy Bitcoins, really, you should have done that by now. Not entirely, but at least 50% of your expected expenses in Bitcoin should be in the market already. All right, moving out of cryptocurrencies, going to talk about the Forex market. I've got to talk about the AUDNZD, who's having an interesting price structure. So basically what we have in here is what I wanted last week, but on the exact opposite fucking side. Instead of closing in here, I would have liked us to open in here and close in there. So we're kind of having a very mixed reversal expectation in here. I don't really see how it goes. We've been breaking the highs. Okay, so yes, there is still some weak resistance on that area. But obviously, we're on potential support area, so this is why we've got fewer sellers. But the problem is the buyers are not necessarily taking the advantage in here. We're still having that bearish bias in here. So I will remain cautious on the AUDNZD as long as it remains closing in that perspective. The thing is that that daily candle close, we're right in a range. So as you can see, we've been going up and down all week long. So the question is how this candle will look like when it will close. It will obviously change the shape of the weekly candle as well, because basically the weekly candle looks like the daily candle. So what we have in here is problematic. If we do close like that, I may expect a new bearish outburst next week to probably chase down lower lows and try to trigger some stop losses of buyers who will have put their stop loss to close from those current prices, which you shouldn't. I stand on this. For now, AUDNZD stop losses must not be set in here, too dangerous area, and we could very well get ourselves down there. And you don't want to be stopped out by just a simple stop loss hunting kind of movement. We're going to have lots of news next week in the AUDNZD. So the question is, if we do close like that, all those news will have to be bullish, otherwise they will push us to downward. Other thing, if for some reasons at the end of the day we find some bullish demand on AUDNZD, and if that candle manages to close in here and make us close the week with a lower shadow candle, if we do that, so it would probably say closing above 1.066. If we do close above that, I would say yes, positive bias heading into next week, and I'll probably take a tiny reinforcement ahead of the weekly candle close, just to probably expect us to gap upward next week and go higher. Because obviously what we're doing right now in terms of a weekly, what that candle says is that if we make a lower shadow candle, that's a bullish bias. We're obviously going to push higher next week. And it's going to be a nice bullish week. You can expect trends in the AUDNZD, bullish trends next week if we do close with a lower shadow candle. And in that perspective, I'll be ready to reinforce with a stop loss below that low, which means the reinforcement I will make will probably be done with an invalidation, but probably targeting us to get back to this, which is the 15-minute context. Okay, so 2 time frames lower than the daily, and I can expect. Sorry, fuck it. What was it? No, yes, we were trading weekly, so it was 2 hours. Okay. So I would see this, us getting back to the 2-hour context, and if we manage to do this, that's hell of a rebound. Obviously something you want to take, all right? So if next week happens to be bullish, it's going to be straight bullish, and you can expect trends all week long from the first day to the final day to get us probably near, or let's say above 1.082. Approximately. I expect this. I expect next week to get us back to that previous range area we've been building in here. So you can expect price to shift out of here to go set themselves in that area next week if we do have a bullish reactivation today. And everything suggests we kind of, I really expect that to plot. We've got a bullish reversal right here on the context. So now the context is bullish. We're into buying opportunities. I would say this really looks like a wave 2 kind of pullbacks. Wave 1 in here, we managed to break a resistance, so we just made a tick out of here. That's the breaking the weekly candles high that we've done in here, okay? It's just a tick above, but we've managed to do it. So it will look like, in terms of structure to me, like a wave 1. We're building and searching for wave 2. Whenever we find it, it's going to be wave 3, extended wave 3, then wave 4, 5. But we can very well expect the trend to play its game next week on the AUDNZD if things can manage to show us some early signs that this is what we're trading. Okay, in terms of timings, generally, when you take the Fibonacci times, okay, you generally take wave 1 out of wave 2, and generally wave 3 is lasting 1.60. Yes, so this is how it is. Just let me see how it goes. No, it's not how it should be. Yes, 160. All right, 1.61.8. So this is the area in terms of timing that we can expect the wave 3 to terminate. So as you can see, fast pace, exactly the same pace as wave 1, but the thing is that it's going to be overextended through time, so you can expect us to be really, really bullish next week if that's what is coming. And I'd like it to be that way, all right? Probably this. God damn it. What the hell's happening? Okay, huge freezes. God, for sake. All right. So we can expect something like that, all right? To get in that area, the big resistances we had back then, probably not breaking them or reaching out to that Fibonacci level seems like a really viable option to me to terminate that wave 3. So bear that in mind. If we do have positive or at least positive forecasting closing kind of week, then you may expect this to be great next week, okay? So that's to expect. Otherwise, option number 2, if we manage to close out the lows this week, we're going to wait for breakup trades next week, and probably those breakup trades will be done near that area. Means if we go there, I'm ready to make buying breakout entries, buying breakout reinforcements, okay? So kind of speculative buying area in here, searching for bullish signals, which we don't have so far. We have no bullish signals, but if we do have some, I'm ready to buy them. If not, then that will be a breakout trade. All right, out of this, I've been reinforcing my yen exposition at the candle close yesterday, so yesterday evening, because in a daily chart perspective, what we have is still positive. Yesterday candle close, even though closing lower than the open, still remains closing above previous day's highs by breaking clearly above the highs, and what we call the HL2, which is high plus low divided by 2. It's the minimum, it's 50% of the average of the high to low ratio, is also above the previous day high. So closing above the previous day high with a high low, with a median price above the previous day high, is really a bullish candle. So out of this, even though it looks not that bad, that good, it's still a good and positive answer of prices out of that support area. I still expect us at some point to validate that bullish trend channel, to get out of the lows, getting to the highs, and obviously there will be no resistance in here, so we're probably going to have to extend that bottom formation, so wave 1, 2, and wave 3 ahead of us in my perspective, so we can expect trends to play their games in the yen part pretty soon. So I expect us to trend probably next week, and we'll see how it goes. So in that perspective, with the rising yen, question is how the dollar will react. The dollar really wants to fight back. It doesn't want to surrender. It's kind of a freaking hard battle. It's been lasting for way too long. So whenever this trend will trigger, believe me, it's going to be brutal and vertical. You can't expect something like that to happen with way more than 3 days. If the dollar surrenders, you can be damn sure that the dollar yen is going to be a falling knife. So question is how it goes. Fed's been has been negative, but for some reasons we're kind of invalidating the bearish bias today. So we'll see how it goes. The weekly candle close is like a big mystery. We're into very strong resistance area. Signals are taking profit and overbought. So we've had taking profit and we're now overbought below resistances. Normally, if this is bearish, we're going to have bearish reactivation, kind of a first bearish impulse, retracement, second bearish impulse to come. All right. So the thing is that for now it still remains dangerous to trade really aggressively. So I would say in terms of dollars, don't be leveraged for now. Can't be leveraged on the euro dollar. Can't be leveraged on the GBP USD, as today's candles are still bearish. But I would say yes, I keep on having my bearish bias for the dollar. The thing is that the market doesn't want to validate. So I think if it does that someday, it's going to be brutal, because I see no support to happen in there. So if we go down, it's going to be a straight line. It's kind of, the market will surrender. It will say, okay, we tried hard for many weeks in a row to handle all the upward movements, but we apparently can't do that, which means if we reverse, we're going to break the support trend line, and we're probably going to install an oversold momentum. So we're going to go wait from overbought to oversold, and you can expect price to probably be really, really bearish in there, and I expect price to probably do this in a straight line, which means we're not going to have buyers for a long time heading into dollar, and I think that what we may expect afterwards is another just rebounds, technical rebouncing, risk management, and probably double down afterwards with a nice bearish outburst. That's the plan I'm trading. The thing is that for now it's very dangerous to know that. As remember that we're not assessing, we're not making magical trend trading or magical reversal trading. What we do in here is managing the risks. To me, the risks are managed enough to consider that we can eventually try to trigger bearish entries out there. But as the market keeps on trying to invalidate, we'll have to trade that cautiously. Means we're taking a statistical and technical advantage out of the market, which give us slightly better opportunity to make gains rather than losses. But the thing is that at some point the market won't be trading technicals. And if we're in such cases with the dollar, then we're probably going to have a price distortion and irrationality. Sorry about that long break. I had to take care of emergency things out there. So anyway, I'm just going to finish that show after talking about that nasty dollar and move on to something else. Wish you guys a great weekend. So yes, just to sum up the core informations in here, the thing is that if the dollar wants to extend that weekly chart time frame, possible uptrend, that isn't, to me, because if we have a look at the monthly chart, mostly looks like a bearish range, suggesting that in here we might have made major topping structure by a nasty divergent pattern, which means what we have in here is another divergence on the way, which we call hidden bearish divergence, which means the bulls are trying to fight back, but they already lost that battle, suggesting that what's next to come is a bearish wrong footing pattern. And that's, to me, what we should be really focusing on trading instead of trying to hold on and to that bullish vision of dollar, which seems really biased to me. Yes, we've been recently bullish on dollar, but comparing to the previous bearish trend we have in terms of strength, to me the bears really are a lot stronger than the bulls. And what we have in here really looks like what it is. A hidden bearish divergence is the visual translation of something that really shows a psychological pattern. Bulls are exhausting themselves in here. They're putting out an enormous amount of energy, and that's what the momentum is translating through prices. The price energy. We're spending so crazy amount of bullish energy to try to fight back something that the bears really managed to take over last year. Not 2008, 2017. So 2017 bearish trend on dollar is really overcoming what we're trying to achieve right now with a bullish dollar trend in 2018. So yes, it really sounds like a retracement to me, retracement that will lead to lower lows afterwards, and probably a bearish invalidation, because that's how it goes when we're trading ranges. We're trending on uninteresting prices. When we're done with bearishness, we catch up on bullishness. But when we're done on bullishness, we're going to catch up on bearishness. So this is what we may expect in the dollar in the next few years. At least that's what I'm trading ahead of. Doesn't mean it's going to happen, but you need to have a vision. You need to have a projection through time. And this is what I want to trade. If I'm wrong, then I need to assess the risk I accept to take to be proven wrong. And so far, those risks are pretty limited, which means I accept the price to go a little bit higher. But what I have in front of me, and we're nearly closing that month, is really suggesting that we're probably off the trend. And if we manage to reactivate this, it's probably going to last, what, another quarter ahead of first quarter of 2019. But anyway, at some point, 4 to 5 months from now, we're probably going to have a bearish trend to play. And if you look at this, we're 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 months of trying to retrace. And generally, trend trades tend to last 9 to 12 candlesticks. An average cycle, in terms of sine wave cycle, is generally plotting between 15 to 25. And those 15 to 25 are generally splitted 3 on 1, it's 2 versus 1 for the trend trades versus the consolidation. So we're trading 2 times higher than we do consolidate in terms of, it's not exactly, it's approximately the 61 ratio, 61 to 38, approximately this. So we take an approximate, an averaging. So I said 15 to 25 bars as a scale for a general cycle. So let's take 20, which is the average in here. And you split that 20 by 61 to 38.2. And what you basically have is that ratio of 12 to 8. So generally when we retrace around 8 candles. When we trend approximately 12 candles. But of course, these are not just numbers that will show up every time. You consider this as averaging. So when we retrace, the average retracement is generally 8 bars. We're 10 bars retracing. So how does it, and we can consider this one not to be a retracement. So we'd say we started breaking candles high up on this one. So we're 9th month into bullish retracement out of a bearish trend that lasted those 12 bars. So I would say yes, power is in the bearish hand right now. The question is, how long will this take for that bullish retracement to exhaust and to recreate bearishness next one? Just basically playing that divergence. And when those kind of divergences, the hidden divergence shows up, generally they lead us to break the previous lows and to create some kind of trending. So it doesn't mean we're going to go all the way down to the cave, but all it suggests is that probably we can expect some trendy moves next to show up bearish dollar, probably retracing back to previous resistances. We've shown strong resistances back then. We crossed through them, which means we've got strong support right now. Strong support that never got tested again. So yes, in a long-term perspective, I think the dollar is about to retrace to that area. And we're going to see if it acts as a support or not. And generally, through time, in ranges, previous supports tend to have early reaction, but we generally tend to break through them. So what I forecast is to go there, test that level. Probably the early reaction is going to be bullish, but I don't think we're going to be that bullish. And I think we might have a final fifth extended impulse. So I would say in that range, we still have probability to make huge trending move, but not now, in a few years from now. But we might search for the early triggers of that trend trade to show up in the future. All right, so these are my arguments. Once again, don't try to convince me I'm right or wrong. I don't really give a shit about that. All I care in here is to try having a vision of the market one step ahead and to see if prices tend to confirm that or not. For now, prices tend not to confirm. Yes, we have strong bearish signal coming from the indicator, so on a technical perspective, odds are in my favor, but that doesn't mean I'm going to win. All it says is that my strategy is giving me the green signs in here, the green color. I can go for it. The thing is that doesn't mean it's not going to turn out to be a red light in the end. I don't know. Future will tell, but that's not what trading is about. And we're not here to try to figure out what the future will be, just assessing how much we risk to be proven wrong and hoping that we will be proven right, obviously. That being said, I'm going to wish you guys a good weekend. Today we have a very nasty candlestick pattern on General Electric. I'm showing this right now, so just before we get this finished. So as well in here, in a weekly perspective, we're about to close very nasty. As well in a monthly in here, look at the month, 2 months from now, we're crazy bearish. So I'm still trying to wonder, we're in very low volume area in historical prices in here, suggesting we have strong demand in here. So I'm just trying to figure out if the market just doesn't want, if we're not just trying to face a market that just wants, let me zooming in here, you're going to see this a lot more clearly. So this is where we've got the lowest amount of volume, and we've been trading those prices, suggesting we're in strong bullish demand area. And I really wonder what the reaction will be. Are we going to strongly reactivate bullish out here? Because simply we won't have sellers anymore in that market. It's going to be a buying only market with sellers rebuying themselves out of this market. So double buying pressure to be forecasting. Or option number 2, we keep on falling and we're probably going to have to make a lower low, and that's a possibility. I just don't know what the answer will be. I just think that those 2 bearish waves we've made earlier are more than enough to consolidate the strong bullish trend we had back then in the 2000s. So I would say yes, to me that seems more than enough of a consolidation, but the market could just decide to prove me wrong if it has to go even lower than that. That's a possibility. I'd say we're trading the monthly context, so we're supposed to find bulls in here, but for now we just don't see them. We see very aggressive bears instead. And the question is, we'll see how long this can last. If the bears keep on holding their strength, then they'll just push us to new lows. If they fail at some point and have to buy themselves out, we're going to have a buying only market, and it's going to be very nasty. Because when we have buyers only in a market, oh gosh, it never ends well. But that's how it is, okay? still trying to find ground prices for General Electric. Basically, we're kind of invalidating that bubble, and clearly is all the elements of a bubble. We've got all the visuals suggesting in here was bubble trading. So yes, we're kind of crashing out of that bubble, and we're still digesting this, but doesn't mean this thing has no value. Okay, General Electric is still a company, still have assets to trade, we still have things built and sold. So yes, we're still trading something some way, and I think that this thing is not going to go back to zero. I don't see it that way. So yes, I still have my bullish vision in here, and I'm going to set this thing right in front of you. I'm still 3 on 5, which means I'm fully speculative leveraged in here, which means no leveraged on position sizing, but I'm maximum leverage authorized by a speculative entry, which is in here the buy and hold. So I've been putting all the money I have to put in that asset, which means I'm not going to add position sizings. I'm just going to wait for this to validate the bottom, and basically I'm just holding in between to just cap on the to just basically catch up on the short-term volatility. So I'll just let it go, wait for the short-term bears to terminate their game, and when they'll do, I'm probably going to have a strong bullish reactivation. But so far I just need for that speculation to play and for the bars, the price, the actual price, to show me that this is what's happening right now. But obviously on a monthly chart basis right now, what we have is not good. Clearly it isn't. We might be about to close at the lows, because today is going to be the last session of that month. So today is going to close the month in General Electric, and obviously this is not a good close. This is a close that we need to talk about. I rather like to have the market not closing at the lows. I pretty much like to see the market buying itself, at least buying itself a little bit to close. Let's say I would like at least a little bit of a retracement in here. So let's have a look at this in a daily chart perspective, okay? Or we can just close at the lows, okay? Let's forecast this. If we get to close at the lows, after this, look at what that candle today's candles looks like. We've been gapping down and selling for now, but we'll still have half the US session to go, and could very well change today's session's shape. Yes, we've been breaking previous day's lows. Yes, okay, but we're still having a positive momentum out here, which means we're trying to build a bullish momentum out of a very, very weak chart. We've been strongly bearish. I've rarely seen that much bearishness in a market. So we'll see how it goes. But if if for some reasons today is not holding that bearish gap, and if instead we're buying at the end of the session, buying strongly to close in here, or even closing higher than that, closing positive today, will be a strong sign that the bulls have it in control. If we have that, I may even consider making some speculative entries again in that market, so low leverage but with a stop loss this time could be an option. So I'm closely watching at General Electric. Basically, if I take that trade, it's going to be 3 p.m. 59. It's going to be 1 minute before the closing bell. If I take that trade, it's going to be this. All right, I'm just waiting for the close. Depending on the close, either I'm going to eventually take a tiny speculative entry again on General Electric, triggering some kind of retracement, or even worse than that, a V-shaped reversal. Because I strongly think that we have a highly polarized market, which means if we get to reverse those poles and turn from strongly bearish to strongly bullish, because that's how it's going to end. Don't expect the market to build ranges in here. It's not going to be the case. We're trading late trending on the daily and weekly charts. We've been strongly overselling in bearish, suggesting we're in the context that we're probably going to have a V-shaped reversal, which means we're going to switch from bearish to bullish. Don't expect the market to range in between and go neutral. I strongly expect that we're going to be coming bearish to bullish. But in that perspective, eventually, if I do trigger that new speculative entry, I'll probably secure those gains and lock on the trades. So I'll have a risk management, but I'll be aggressive. You have to be this, okay? Probably I'm going to target those retracements, no more than that. But getting in here, I'm probably just going to take 15 or 20% of the trades off the table and keeping 80% of the position sizing all the way through, because I think if we reverse, it's going to be brutal and we're going to restore back to the previous support. Because if we have to test the resistance, we clearly build no one in between. So the latest support is going to act as a resistance, which means the latest resistance out of current prices is rising 40%, and it's even 50% rising. Okay, so yes, that's an opportunity. It's a big number. Clearly, it is rising 50% just like that. It is also a big number, but we have to assess that we've been downgrading the prices. As well, for what I think is not really viable reasons. We've been overselling. The market cap is pretty low right now, and not suggesting that I suggest we're not nearly following the fundamentals in here. So at some point, buy and holding in here is kind of an option, at least a low risk entry. That doesn't mean it's going to work. You know how my work is and what it relates to. So clearly no future telling in here, nothing close to this. I just think this is a low risk entry that enters my strategy's boundaries. So of course I'm going to take that trade upon candle close only. All right. That being said, I'm going to leave you guys in here. Finally, a little bit a last word about Tesla, because I'm going to take a short on Tesla as well today. Not necessarily today, but probably just early Monday. But anyway, anytime we're going to get ourselves back to those prices, the one we're currently trading actually, I said right now I'm going to be taking a short entry. So let's consider that I'm going to take bearish trade, and probably I'm going to take it today. So yes, we're going to do it live. So I'm going to watch out for intraday signals right now. I think 15-minute chart is going to be more than enough to trigger. I would expect to wait for a late today's session, so wait for the late time of that session. We've got strong latest resistance in here. I think that this is where, or slightly above, that we should have the bearish reactivation, right in the context actually. So the thing is that, yes, we're still double bearish in here, so we're looking at bearish trades. Obviously, I am. But the thing is that I think this is where the big game will play. In here, we're testing that first Fibonacci level in here, $350. But as we've been crossing with a candle close at 350s, I would suggest this is the area I want to sell, but not necessarily early selling that level. Okay? So I would watch out closely for what for how it looks like when the candle will close. If tonight we're closing in here and rejected and never printed any price above 350, then yes, I'm selling, obviously. But if we're holding those prices in the next few hours and having a final rise right into the expected selling area in here, I would say any price. Okay, just look at that. This is how I work. So I think this is what has the most value in here. When you see me building a scenario, not just telling you what I'll do, but how I build that. Strongly resisting in here. We clearly are. We've been gapping down that area, trying to find a resistance in here. So have a look at this, okay? In a volume perspective, this is what we have. I would say that's the minimum resistant level. So I would say in that selling area, any selling signal is good to take. Obviously, it will. But this is where you have the best price to play that game. So I would say trying to sell anything above $353 is going to be interesting selling prices. Okay? And I would say that Fibonacci level in here is the 76.4% retracement is the most attractive price to get. So most attractive price, fairly good prices to sell, and definitely good price to sell as well, but not the best, all right? Not a worst price to sell, let's say. We need to sell in here, but we just try to figure out what the best prices are, and I would suggest we can go just higher than that. Try to break that session's highs, just to try testing how those prices react, and they probably will react bearish. All right, obviously there will be a stop loss above the market top. That's a certainty at that point. If we go there, it means the context has been changing, but I strongly suggest that we're not, and we'll see about that. Okay, but fairly interesting risk-reward ratio in there. So yes, I'm going to take a trade if I do have a 15-minute signal above those prices. What I'm going to do just right now, I'm going to do it right in front of you, setting a fucking alert, and I want an SMS in here just to make sure I'm not going to miss this one. So it's search bearish 15-minute signal. All right. Okay. So that's how you do things. You build a scenario, you wait, So you put alert for the waiting time to play its game. I need to be assessing that I have a 15-minute delay. No, I don't have. No, it's real time, but I do have uncompleted, which means the updates are not made in real time. Anyway, all right. That's probably all I have to say. I'm not going to go straight shorting Apple again. I just wait for this one to retrace a little bit more, but we're going to talk about that on Monday for next week's scenario. But over week, I would say Tesla could be interesting to take on Friday's Eve instead of Monday morning. Obviously, we got G20. That's going to be a game changer. But I think ahead of this, we have to talk about trades that may be triggered early on top of this event. Just having a quick look. Oh, geez, AUDNZD is falling apart. So yes, the market is strongly trying to reverse on the euro dollar. Is trying to show strong dollar. So we're trying to reverse what the Fed's been saying recently. And that's how it is. Oh yes, we're going to have to talk about the bonds. Yes, the bond market, I think, is showing something really interesting to play in the next few days. This one, we're going to talk about that in the next sessions. But basically what we have in here is really interesting. I think either we're going to reverse in here, but I see no signals of strongly bullish reactivation. So yes, we're oversold. We'll see how this will lead us. It's not a perfect signal, but that's a tradable signal. So if we're going back to resistances and breaking them up, I think we'll have a breakout trade to trigger out here. Otherwise, I would suggest this overselling would have been better if it happened right at a Fibonacci level that we have right below us. So I would say kind of this signal is something you can take, obviously. But I don't really know if this is something to take just right now, all right? Because yes, we've been building a double top structure and we're currently trading below that double top activation level. So either this is a fake breakout and we're going to rise sharply and very, very brutal. Or option number two, we're going to have a falling dollar and falling 10-year yields, which is the worst case scenario because we're going to have reverse yield curve to be playing its game pretty early and pretty soon. Let me just add the 2-year yieldings on top of this. Yes, I'm sorry. I thought we would make a quick show today, but we have got lots. We have lots of things to talk about. So just have a look at this. Today, what we have. Sorry, scale P on the right. Okay, just have a look at this. The 2-year yields, I think, are going to strongly bullish rise in the next few days and weeks. So I expect the 2-year yields to be strongly bullish in here. And as you can see, they've never broke through those supports. So we're still strongly trending in 2-year yields, which means look at the gap between the two. Okay, we're very narrow. We're just 20 basis points ahead, which means 20 basis points is going to be narrowed pretty significantly. And I expect this to narrow and play again the next few months. So we're probably going to have the first crossing from a decade of the yielding curve, and that's not going to be a good sign. Doesn't mean the stocks will sell off. Obviously not. It's a long run thing. But when these things tend to reverse, we know that the party is over, that the music is soon to stop. It's not going to stop instantly. Obviously not. It's not a selling signal when the yielding curve reverses. It's just, it says, game is over. Stop buying. The trend will probably stop and reverse in the next few quarters. So I'm waiting for this to play its game because it seems normal to me at that stage to see the yielding curve reversing, and it's not a Fed problem. It's just at some point maturity in trends just have to play their game. And when you're maturing trends, long-term trends that plays the economy, then at some point the yielding curve reverses because we've got a negative outlook in the short run and still having a positive outlook in the long run, suggesting the market is suggesting high probability of a recession to show up, but a recession that is not going to last more than a few years, and that 10 years from now we'll still have a good shape in terms of economic vision. Okay, so that's what it says. So the yielding curve reversing is not end of the world kind of death cross thing. It's just the exact same thing. Yes, at the moving average is death cross. It's just something that shows a change in the long-term psychology. All it says is that we're probably not going to break to higher highs afterwards. When you have reversed yield curve, anytime we're going to try trading at historical highs afterwards, it's probably going to be a trap, which means you're not going to buy historical highs if we go there again. It means it's going to be a trap for stupid bulls to buy at the highs at the top, which means if we reverse the curve, that's the first step to cross. We still haven't, so it remains speculative. If we do, and if on top of this we decide 2019 to go trading the market tops again, trading historical highs on the SPX, for example, it's probably going to be a trap. So you're going to have to wait for another quarter or two, but it's going to be a big short selling afterwards because we're going to make an excessive price trading. All right? So we're going to talk that, we'll talk about that right in time, obviously, but you need to bear yourselves in mind that scenario, that what we are facing in here is probably the fact that if the 2-year yields reactivate, it's going to it's obviously going to reactivate a lot stronger than the 10-year yields, but probably that the 10-year yields as well cannot go lower. That's what it says. Okay, 10-year yield is going to go. It's not going to go lower. It's going to rise again, but the thing is that it's going to rise at a slower pace that will do the 2-year yields. That's all I'm saying, okay? So watch out, guys. That double top structure is dangerous to trade bearish for the reason that the 2-year yields may just try to reactivate pretty soon. We're trading a trend line right here. Whenever this one breaks up, we'll have a strong buying signal in the 2-year yields, and I see absolutely no reason for us to change that course. And we're still having a wave 5 to build, which means we'll still have some bullishness in the yielding. So don't expect this game to be terminated already. Clearly isn't. This is really showing signs of a wave 3 kind of trading. We've been consolidating in here, A, B, C, okay? So we're terminated. We're creating wave 5. In terms of structure, this is how it goes, okay? The consolidation has been playing like that. We've been building wave 5 out of a wave 4 pullback. We've made an A, B, C structure, okay, extended flat consolidation, which is very, very rare scenario, but it happens, and it happened right in here. So it means when you do this, okay, the extended flat consolidation, it means high tension on the market. And we've clearly seen that this has been creating stock market turmoil recently, the yielding behavior. But that doesn't mean the yielding will reverse. It's just we have volatility out there, but still in a bullish trend. So you might expect still some bullishness to play. Okay, so even if the Fed has been changing the vocabulary, doesn't mean they're going to stop rising yield. It's just probably we might expect just 2 or 3 hikes in 2019 instead of the four that the market were pricing in back then. So something has changed, yes, but not the overall course has been changing. It's just we might reshape, but there is still a 5th wave to go in here. So don't expect the Fed to stop rising rates. It's obviously not going to be the case. It's just they might slow the pace, which is normal at that stage. We're probably going to trade wave 5, which means this is where the Fed's been rising at fast pace. Now we should expect that pace to slow down. Okay, but have a look at the perspective in here. Do you really think that this perspective is going to change? I don't think it will. All I think is that we still have a wave 5 to build, and then we're going to have the reverse yield curve. I mean, we're going to range in there. We're going to consolidate both those curves, but in a negative outcome, which means the 10-year yields are going to consolidate a lot more than the 2-year yields will probably do. This is where we're going to have the reverse curve. We'll still have a wave 5 to play afterwards, okay? So have that in perspective. Long-term bonds will just reverse, but the short selling is not going to be now. It's going to be probably there, okay? So late 2019 or at least mid 2019 to expect, okay? So probably expecting another burst to terminate wave 5. Just go trading slightly higher than that. I expect probably 3.40. I think that this time, anytime we go back to trading at the context, is going to be sold. So it's going to be a selling entry to make out there for a consolidation. And probably you can expect the market to range in between for a bit. And then big wave 5 with the recessions, okay? With the recessions heading toward us, and we actually do the recession trades, obviously the market will switch to safe havens, which means we're going to have yieldings going down because obviously those who've been trading in the stock market will kind of go safe haven trading into long-term maturities on bond market. So they'll buy 10-year yields. which is going to drive the yieldings lower. So generally, when we do make the recession trades, when the stock market is actually falling apart, this is where we've got strong bullish demand on the bonds. And obviously, that's. So if you're expecting some kind of timing, this is during that timing that we should have the bearish stock market. But I still think there's a long way to go in here. It's just that in terms of pace, if you assess those two things, this is what I forecast us to do. Okay, having both of them reaching out to those levels in here, probably not in the same. Okay, just look at this. Okay, we're gonna isolate this one. Just have a look at this one. Okay, and figure out this. Okay, we can clearly see this and this. Okay, it's a trend channel. All right, obviously we're trading in there. Okay, that's what we're trading. You can expect another rebound. So in terms of that curve in here, you can expect some, fuck it. Let me just unpin this. All right, let's just do it again. Okay, that's how we'll probably do it. Getting in there, okay, and then consolidating, reversing the yield curve, okay. When you see this, do you see that? Okay, we're probably going to reverse the yield curve at that stage. Okay, bullishness, but fairly slower bullishness, and then bearishness for everyone. Okay, that's how it goes. Okay, and this is how it goes. But you can expect the negative yielding curve to play its game. We're not going to go that high. Sorry about that. Probably 3.60 is going to be more than enough. But you can expect something like that. Probably at this point, we're going to have a strong surge in the 2-year yields. We're going to have a strong, crisp reversal and crisp risk increasing into short terms, which is going to drive short-term yieldings at very crazy high levels. So it's hard to figure out what the top will be in the 2-year yields at that stage. We're probably going to have strong problems in the bond market at that stage, young bonds exploding and things like that. So obviously it's going to push short-term maturities, 2-year yieldings, for example, to probably trading at stupid levels for a short-term perspective. So you might expect some vertical drops, some vertical movements out there. But when you'll see those movements, you'll know that we're mature enough heading into some huge bearishness, or the next step ahead for the stock market to break down major supports. And in order to break monthly support, we have to check a few crosses. Those crosses are, first, we need to have a reverse yield curve, which we're going to take care of, I think, in the next few days. In the next few weeks. Okay, and expect this to be the future of damn it. This is still, yes, this is our black line. This is our blue line. Okay. So expect this to be playing this way, okay? This line versus this line. And this line is going to slowly cross above this one, because this one is not going to slow its pace. It's going to keep on trading that trend channel, I think, and not going to slow the pace. Even worse than that, we're going to accelerate that pace whenever things will probably turn out to be a little bit more risky ahead of next year's summer. I think I expect us April to May probably to expect us breaking on top of that channel out of the 2-year yields. Okay, because that's going to be the most dangerous timing, when we'll know that we're heading into summer. Summer means lower liquidity, so higher volatility in a market that will increase the danger. So high danger, low liquidity, high volatility expected. Probably this is where the market will show the most dangerous risk management. So obviously this is where lots of traders will ask for better premiums into short maturities. Okay, that's how it goes. That's the perspective you should have in mind right now. Okay, expect that yield curve to reverse slowly but steadily across the next quarters ahead of that consolidation, which means the 10-year yields will probably consolidate a lot deeper than will do the 2-year yields. And in the same time, please don't trade the German yields the same way. We're going to have a change for a simple fucking reason. We're terminating fucking QE. So at some point, either the ECB is going to extend QE, or we're going to have a problem, because we cannot trade the German 10-year yields just like at the 10 years US yield, because we have very different situations out there. We're not terminating a QE on the US yields, but we do have to terminate QE out of euro area, which means we're going to have a change in monetary policy, and obviously it's going to impact the bond market. So I'm still waiting for this to play its game. At some point, right now, the market has been deciding to close at the lows, but you know we're going to switch maturities in terms of expiration. So next month is going to trade another 3 months contract in 10 years German yields, and you can be damn sure that the first second the new contract is going to be available, I'm going to buy it instantly, or sell it. I'm going to sell in the bunds, okay? What I'm trading actually is this thing. I cannot trade the 10-year yields. I don't have access to that liquidity, but I do have access to this, which is the bunds. And I expect the bunds maturity just like it does. Basically, last time I've been fucked up by the contracts rollover. So basically, the new contract is trading way lower than the next one because those contracts have a 3 months expiration. I expect us to work out that resistance, probably going to stay there, but next contract is going to open right here. So we're going to have expectations that the 10-year yields will will rise, and obviously the bunds contracts out of the next 3 months expirations are going to trade at much lower prices than the one we're trading right now. So yes, I'm probably going to have to lose my gains in here, just like that. Just look at this, closing the contracts at the high, reopening at lows. This is exactly what I expect us to do. But I think this time, this low is not going to it's not going to hold. We're going to break this one down. I expect us to go way below this, which means take that as a 10-year yield. Okay, it means we're going to, sorry, not in the US, in the D, yes, we're going to break this high. So I expect the German yieldings to break through 0.6%, and I expect us to work that area, okay? I'm probably going to have to rise even faster afterwards, okay? So have that and bear that in mind. If we do take the spread, okay, let's just have a look at this to terminate today's show. Let's make US 10-year yield minus the DE 10-year yield. So we're studying the yield curve spread. We've been studying the reverse. I expected this reverse to play sooner or later. It's already on the game. It's playing since last week. We're strongly reversing, which means we're at it. The 10-year yields will slow down on the US, but will accelerate in the German economy. So you can expect that trade to be probably one of the most profitable bond switching trades to come in the next few quarters. The switching out of US bonds to Eurozone bonds. All right, so obviously when you have this, strongly suggesting that we're going to have a strong euro dollar as well. So everything pointing to a weaker dollar, but yet everybody tried to think that the U.S. economy is the one that you have to put your money out there to, and that the U.S. is the safe haven and shit like that. We'll see if I'm wrong, but so far everything I see in front of me suggesting quite the opposite, that the dollar is going to be the place you shouldn't be getting yourself into because it may be losing a lot of its value. And that if you are searching for safe haven in terms of bonds, you should expect those bonds to be taken out of the euro area in a short-term perspective. So I would say 6 to 12 months, I think the Eurozone bond market is going to be way more interesting than the US. And I'm not talking about holding them till maturity. I'm talking about buying the bonds to sell them at better prices. All right, okay? Just that. To basically play the game of the bond market to restabilize out of QE ending in the euro area, to kind of because the ECB is going to have to strongly rise interest rates and pretty soon, otherwise we're going to have problems in the euro area. Okay. So sorry, we went a lot more than expected in today's podcast, but I hope you guys have been learning some things in here. Bye guys, wish you a good weekend, and see you again on Monday, or in Twitter or Telegram. If I'll tell you through Telegram if some major things are happening in the crypto market during that weekend. Bye guys.